Realty Income's third largest tenant, Dollar Tree, plans to close 1,000 locations. This could be potentially bad news for Realty Income, but I'm here to calm some fears. Realty Income is a decent holding in my portfolio, which I will show at the very end of this video. So this news definitely brought some worry, but after looking into it, I am certain Realty Income can easily cruise through this while continuing its revenue and AFFO growth. Now, Dollar Tree represents 3.3% of Realty Income's total annualized contractual rent, so a small portion. Now, Realty Income leases 1,229 locations to Family Dollar and Dollar Tree. Now, Dollar Tree acquired Family Dollar, so when I talk about them, they're together. While this seems like a lot, 1,229 locations, it represents less than 10% of the dollar store's total store count. So Dollar Tree and Family Dollar have more than 16,000 locations. So in other words, we can assume that a very small percentage of the 1,000 store closings of their 16,000 stores will hit Realty Income's 1,229 locations. I think a lot of people are seeing this as Realty Income's locations will go from 1,229 down to 229. That's not how it's going to work. Only very few will be closed that Realty Income holds. Also, Dollar Tree will be conducting these closes over a multi-year period and will wait for the lease terms to expire for all the identified locations. So if any of Realty Income's locations are at risk of closure, Dollar Tree will continue to pay rent until the lease is up. So this provides some predictable income for Realty Income and allows them time to find new tenants. Now, Realty Income recently acquired Spirit Realty, another REIT. And the benefit here is that it broadens Realty Income's reach to grab new potential tenants than if they did not acquire Spirit Realty. So more chance they will be able to renew those leases affected by Dollar Tree closings with new tenants. Plus, Spirit Realty is going to bring increased revenue for Realty Income, so there is some added cushion there to offset any potential lost revenue from those store closings. Now, Realty Income has an occupancy rate of 98.6%. That is awesome. This is towards the high end for REITs. Many REITs fall closer to the 90% range, where Realty Income is closer to the 100% range. So there's confidence based on Realty Income's proven history to keep its properties filled, and I will show a chart at the end that'll really prove their strength here. So no, I do not think this is a major hit or risk to Realty Income. In fact, I think while the news keeps fear in investors and while the Fed keeps rates high, now is the time to accumulate shares of this quality REIT with recession-resistant tenants. Let's take a look at their top tenants and other company profile data just to show you how diversified and high quality this company is, and we're also going to look at some financials. So we look at the map here. This is where they hold properties, and you'll see internationally they're in Europe. They also hold some in the Caribbean, and then I circled they have some in Hawaii because that's just very small to see. And if we look at the top 10 industries, we'll see the dollar stores make up 7.1%. Of that, Dollar Tree and Family Dollar make up that 3.3%. So really, it is a very small part of their total count when it comes to industries and their top 20 clients. We'll see here that it makes up that 3.3%. Now, the other dollar stores that they own are Dollar General, which makes up more at a 3.8%, but those ones are not being affected by any closings. They also have Walgreens, which is tied. It's kind of like their top two tenants are tied. I do not like Walgreens. That's the one thing I don't like with their client list here. But really, you look across this, they have a lot of recession-resistant clients. So this is great to see, and it's very diversified. If we look at the top 7 regions, we'll see they have 12.6% in the United Kingdom, and then it follows with 6 states here in the United States: Texas, California, Florida, Illinois, Massachusetts, and Ohio. All very robust states with growth because they have strong economies. Now, property type diversification. A massive 81.8% is in retail, but as we saw, a lot of those properties are recession resistant. You know, you have health clubs, you have the Dollar Trees, you have CVS, but also they have 12.7% in industrial. They have 3.9% in gaming, which is more of a new property type for them, and I'm excited about it. They also have 1.8 in other, which I'm happy to say they just announced that they're going and investing in data center properties. So all great things, they're expanding, they're diversifying. Now this chart on their portfolio occupancy, just to show you how durable this company has been over the last 32 years. They've held their occupancy in the high 90s, which shows that they have a proven record, and that to me should bring some high confidence with this company that they can continue this into the future. It is extremely well managed. Now let's look at some financial data. We'll see here, now these are charts that I just created, so if you like these, let me know. And we're gonna look at adjusted funds from operations for Realty Income. We'll see it is growing every single quarter over the last 2 years. Now, adjusted funds from operations are how you truly value a REIT and see its financial performance. And a lot of REITs right now are struggling with the high rates, but Realty Income is showing they're still growing regardless. This is a great sign. If we look at their AFFO per common share, we'll see here that overall it is going up. And I like to compare year-over-year data. So if we look at 4Q 2022 versus 4Q 2023, it puts it in perspective. There's been some growth there. You need to understand that you got to look at it year over year, not just on a chart basis. If you see a dip and you start to worry, no, how did they do the prior? This to me is a good chart. If we look at revenue, we'll see it's been growing every single quarter. Again, very healthy. This company is solid, and it's proving that management is making the right decisions to keep that AFFO and that revenue growing. Now, long-term debt. You will see that there was a huge spike in 4Q of 2022 to 1Q of 2023. And what that is that's the acquisition of Spirit Realty. Now, this is just how REITs operate. They acquire other companies, other REITs, and they do it through debt. They are highly leveraged, and that's just how REITs work. And we see that they've been maintaining it since the acquisition. So I think this is great. I don't see any negatives here. This just shows me that they saw a good deal, they took it, and I think we'll see in the long term this will play out very well for Realty Income. Now, net income, we will see this one's a little bit more rocky and bumpy. It's solid overall. You can look at it from, first Q of 2022 to now. That's 2-year data. It's grown, but then you can have some year-over-year declines. We see 4Q 23 versus 4Q 2022. But again, REITs are being hit hard. Expenses everywhere have gone up, and that's what this chart kind of shows, is that income versus expenses. But I will say, overall, this is not a worry to me because what is most important is that AFFO. So we see a financially solid company, and again, that growing AFFO is what we want to see with REITs, and they are maintaining that growth. That's going to provide stock price appreciation and safety of that monthly dividend. So now let's look at my portfolio and its performance. We'll see here I'm up 23%. Of course, I have some clear winners in the technology sector. I also have some losers in communication and industrials, but let's look at the real estate section. I hold Vici and Realty Income. Now, I am more bullish on Vici, but I also really like Realty Income because I think it's high quality, and it makes up a decent part of my portfolio, 6.21%. I think anything above 5% is considered a significant holding, so I probably will add some more shares to Realty Income while these rates are high and we have this opportunity. But I will admit, it's probably going to be a slower growth company than Vici, but there's something there I want to say. A lot of people see these companies that are very established and big, and they think they can't grow anymore, but they always prove investors wrong. You look at companies like Microsoft. It's been said for 5 years that they are overvalued. They're too big. How are they going to grow? And they just blow us out of the water with their growth. Realty Income, I think, is going to take advantage of international expansion, also getting into different industries like the data centers, the gaming. I really think this will provide some solid growth for us. So yes, I'm keeping it. I have no plans on selling, and this is my portfolio. Let me know if you have any questions. Also, let me know if you have a perspective with these dollar stores closing that we should have a more cautious stance on, or if you agree with me that it's not really a big deal and Realty Income will continue business as usual. So that's all for today. Thank you so much for joining, and we'll see you soon on Mark Arnold's Finance.